that, we will move on to our next session, which is going to be a panel discussion from valuation to value. Now, to throw light on this evolution, ladies and gentlemen, would like to call forward Mr. Mohit Bhatnagar, the Managing Director, PeakXV. With a round of applause, let's welcome him, everybody. Please put your hands together. Mr. Pranav Pai, the Managing Partner, 314 Capital, to please come forward. Mr. Ritesh Banglani, Partner, Stellaris Venture Partners, to please come forward. With a round of applause, let's welcome them, please. I'd like to call forward our moderator for this session, Mr. V. Keshav Dev, Executive Editor, Fortune India, to please come forward.
Good evening, ladies and gentlemen. It's a pleasure to anchor a session which talks about a very delicate topic in today's market. And usually when you have three VCs on a panel, usually valuation tends to go up. But today we are in an environment where I would call it a perfect storm. I don't know whether the panelists would agree, but the fact that, when Claude kind of unveiled its plugins, it kind of destroyed 1 to 2 trillion of market cap within a week for, the listed behemoths. And when you look at the Indian context from the peak of 2021, where, 38 billion kind was raised, but the past 3-year average is 13 billion. So it's like the new normal. And when you juxtapose that against what's happening in the public markets, with what's happening at the geopolitical condition, that seems to be a case where what the public market says is not necessarily being reflected in the private markets. So my question to Mohit and all the panelists is there a case to revisit valuations within your portfolio for companies which are so-called unicorns? Or is there a need for a sharp markdown?
Thanks for having us on this panel. Look, I've realized in our business you have to measure success and failure in 5 or 10-year periods, not in 5 or 6 quarters. I can assure you in any one fund cycle of 10 years, we will see 3 perfect storms or more. And for us, the only thing that matters is in each time there's a storm, there's also an opportunity for disruption. So with everything that's happening around here, this is actually the perfect time to start up. This is actually the time when you can say, look, AI is disrupting everything. Lots of other geopolitical issues are creating new opportunities that never existed for India. There are new sectors and new startups that we have actually not seen, if you will, in space and precision manufacturing and semiconductors. These are all massive new opportunities that did not exist. So honestly, we look at this almost as, please don't waste a downturn. This is the best time to start up rather than really, think of it as a negative.
Pranav, your take.
Yeah, so I think most of the damage after 2021 is done. So I don't think that's a lingering issue for most people, or if it is, it'll get resolved anyway. So I don't think that's a concern anymore. But I think the nature of innovations fundamentally shifted, that we have to accept. I'll be very blunt. Now the AI companies are saying the $35 trillion of global payroll is their ultimate TAM. So all of us are drawing salaries, we're paying definitely taxpayers. Now the AI companies are coming after that part of our lives. They're coming after our livelihoods, right?
Correct.
We talk about how much meat people are eating, how much lipstick they're using, sure. These are cute TAMs compared to global payroll. So I think given innovation has shifted so far ahead now, I think people are calling it an orbital shift, etc. How you value now, what does valuation even mean, what is a good margin for this business, a lot has changed. So I think 2021 is less of the concern. It's now, like Mohit said, I agree, what is the 2030 winner going to look like, 2035 winner going to look like? Things are changing so rapidly. That's what all of us are more pressed on right now.
Ritesh, what's your take?
Actually, agree with Pranav and Mohit, but I would like to address the 1 to 2 trillion value destruction number that you shared. I think it's a little foolhardy to believe that 1 or 2 companies will enjoy all of that upside coming from AI. We will very much need applications, we will very much need services in the world of AI. And some of that new value will be captured by new companies that we are all funding today. But a lot of that will also accrue to existing companies that are sitting on mounds of data that are all frantically building AI applications as well. So I don't believe in this extreme doom and gloom argument that Anthropic will capture $2 trillion of value from software companies. Because these companies are not sitting idle. They are building frantically for this new world.
Okay. Mohit, while the public market excesses might get adjusted to that, but on the private side, when you today look at a proposal, are you more focused on the valuation or what the founder brings on the table? Has things changed for the way you look at metrics today than what you would have done maybe a couple of years back?
No, it's still the same old business. You gotta, meet a lot of founders till you find the founder. When you're looking them in the eye, do you see a moneymaker or not? Somebody who's got the ability to go long, go hard for over a decade of their life, to be able to adopt and evolve. When we invested in Deepinder at Zomato, it was all about a classifieds business. Did he ride the storm and evolve into a food delivery business? Did he then ride the storm into a grocery business? Vidit at Meesho was a reseller business. Did he ride a business into a consumer? I think you're looking for founders who can build what we call enduring companies, can evolve. To this point you raised earlier, when it's all gloom and doom, there are few founders who will use this AI opportunity to just completely evolve their companies, completely change what they were doing, and it's our ability to find those. In our business, we don't chase value, we don't chase valuation, we're actually just chasing the power law companies, the founders who will actually get out there and be the 1% founders to change. So that's not changed today from what we were doing 10 years back and unlikely to change 10 years forward.
So today, will you look at proposals which have more of AI? I mean, there was a time when companies said that it's digital first. Now today, everything is AI first. So has that kind of become a crucial talking point?
AI is definitely an enabler in every business today. So much like the internet was an enabler, much like the mobile applications were an enabler, this is one more tool available to many companies. One good sign that we're seeing, for example, if there's a lot of AI washing, as we call it in our ICs, but one obvious trend is if you're an AI native company, you're not likely to be more than 10 or 15 people. So gone are the days of people trying to build up 200, 300, engineering team sizes. People are now achieving a whole lot more with a much, much smaller team size, and that's a great giveaway in terms of what's an AI native company.
Pranav, how are you looking at the opportunities?
Yeah, so I think some things have not changed. You still, like Mohit said, you still need a good founder able to deal with shifts in the market, tough competition, tough customers, tough global GTM, whatever. So I think pivot sometimes. So I think that part will remain in the business. But there are some new things happening, new changes in dependencies that we didn't see before. I'll give you a very simple example. Mohit and us are both invested in a company called Darwinbox. They build HR software for large enterprises, a big bank, a big conglomerate, whatever. So it's a zero-sum game. Company X, big company, 100 billion valuation, publicly listed, can either use Darwinbox or Oracle or SAP, can't use all three, right? So if Darwinbox has to win this as a customer, they have to remove Oracle or SAP. It's a displacement. They've done that 600 times now, 1,100 customers globally, 100 million plus in revenue. Great business over 8-9 years. But fundamentally, Darwinbox didn't have any reliance on Oracle or SAP. There was no connect in their software, maybe some APIs to transfer data, whatever. But Darwinbox didn't build on top of Oracle, right? But take a vibe coding company today. They're all in the news, ARR, whatever, right? If they are going to the same customer today, an enterprise customer, and Anthropic, which is here before us, or OpenAI is also going, chances are you're a big global, say, FMCG company. You're going to look at Anthropic pitch to you, we're going to do all of these things, we'll write code for you, we'll run your HR, we'll draft your contracts, whatever, sure. But then the vibe coding company comes and says, we will do a lot of things for you on the coding part. Why will this big enterprise buy the coding solution from this vibe coding company and buy everything else from Anthropic? If he's also built on Anthropic, right? The model is just coming through him. So now there are dependencies that didn't exist before, right? You're weirdly reliant on your competition for the same customer.
So where does the value reside? It's in
Exactly.
Anthropic, or is it on the guy who is using Anthropic?
All three of us will give you different answers, right? And the founder will have a different answer. And the customer will have a different answer. And Anthropic is going to have a different answer, right? Clearly, you'll see it in the news. So I think these are the kind of changes that are happening. We don't have answers to all of it yet. We don't know where this lands. But definitely, is that stopping founders from trying? No. Very good. Is it stopping investors from investing? No. Very good. That's a risk you take, right? This will all land somewhere, but it's changing so fast every day. We're not going to have a lot of these answers very quickly. So that's why I'm saying in the early stage, at least in venture, some things remain the same, some things change radically. That's the nature of the job.
Ritesh, how are you assessing companies today when answers are not very clear, especially when it comes to AI driven?
Actually, I think VC fund strategy needs to change in times of great flux relative to times of relative stability. So if you look at the last cycle, which I would call the mobile app cycle, how we were investing in 2010 versus how we were investing in 2022 or 2020 was very different. In 2010, you would estimate a very high rate of failure amongst companies, but those that do well, I mean, Zomato is a great example, create $10 billion of value. So I think we are at that point in early stage investing where we have to budget for a much higher failure rate, because there's a time of great flux. People are trying stuff without knowing what will work and what will not. And we have to be then disciplined in investing. We have to spread our investments a little more. But those companies that seem to then find product market fit early in a new paradigm, you need to double down on them. You need to, so you need to keep dry powder to double down on what's working, which is different from how you would invest a little later in the technology.
Right. Dry powder, Mohit, you just raised a $1 billion plus fund. So in some sense, you have enough and more dry powder to it. But how are you kind of looking at, like when you say in a flux, it's very difficult to make a call, right? You know, what's working and what's not. And for someone to kind of double down on that, what's the kind of, you know, timelines that you're looking at, you know?
See, at many levels, when we are capital allocators in different sectors and different stages, let me give you, since I've been doing this for a bit, let me give you a historic and a go-forward picture to give you a sense of why we are so bullish. 10 years back, there was one company in India which was public and that crossed $1 billion, and that was InfoEdge in 2015. December 31st of last year, 2025, there were 27 companies that were public and had crossed $1 billion. They collectively were about $150 billion worth of market cap, all the public companies. This is without the phone pays going public and others, but whatever is already public was only about 150 billion. That is a mere 3% of the total public market cap in India. This number in China is closer to 15, 16, 17%. This number in the US is 30% plus. So you just play this forward while we're talking about so much public market activity and there are so many startups going public, this is just the start. Anyone investing in India right now is actually going to enjoy the next best 2 decades that India has ever had. And I think that is our broad thesis.
Pranav, how about you looking at, you know, when, you know, since the topic is on valuation, and when you look at, you know, what's happening, the carnage in the public markets, so are you taking inferences what the public market is saying to what, you know, the founder would want to have his company valued at?
I mean, look, most of the companies we invest in are 2 guys in a laptop. How much ever adventurous I want to be, public market calm, tell me this, tell me that, there's nothing there, right? It's hope and dreams. All of our best companies started like with 3-4 guys, whatever, in a laptop. So I think at the early stage, it's all about the future, it's all about the growth, the potential, the quality of the product, the differentiation, the market. There's like 200 things to worry about. But I think as companies raise follow-on rounds, what we're seeing in India for sure today, we didn't see 10 years back, is a lot more of these IPOs have happened. A lot more of the comms have been established. A lot of these companies in the Series A are not going to be the first of their type anymore. Some other company exists, right? And therefore, every single slice of the P&L is being compared to more Indian companies, not just Chinese or American companies. So I think that's a very good thing to happen. It all happened after 2020, once the regulations changed and more IPOs went live. So that's a very good thing. Second, there's also more domestic capital now in venture compared to even 5 years back. More family offices, more Indian AIFs, more government money, SIDBI, fund of funds, etc. And now hopefully grant money finally with RDI and TDB and so on. So I think a lot of positive changes in the capital markets. That also means these people view valuations differently, they think about horizons differently. So it's not just global investors and VCs in India and whatever. Now there's a new component, new dimension of thinking in valuation. So that'll obviously pull valuations in different directions. And third, most importantly, I think founders are pulling off things that they weren't expected to earlier. We are seeing break-evens in our company at EBITDA in 4 years, 5 years, not 10 years, 15 years, like it used to take. We are seeing companies getting to 100 million revenue in 3-4 years, not 14 years like it used to take, right? So I think there's a fundamental shift that's happened because the quality of the founders have also grown. The quality of the operators has changed. I think there's a rise, orbital shift in quality throughout, right? So I think, like, I completely second Mohit's thinking, there's a lot more to do. Signals come faster, but are we going to expect quarterly results? No. We still have to wait for 10 years for a good winner to be built.
What's your take on that, Ritesh?
Actually, I think the media tends to obsess over valuations a lot more than VCs do. I mean, for us, valuation is actually a fake metric. Till someone is buying our shares or someone is selling shares to us, valuation actually doesn't matter as much. You know, if I say a company is valued at $500 million, it's not as if someone is paying $500 million to acquire that company. All that it means is that in the mind of an incoming investor, the value of 10% of that company, they are willing to underwrite 10% of that company for $50 million. Which is fundamentally different from the valuation of a public company. So, to be honest, we think of it as a derived metric. Sometimes we have to pay a little more to acquire stake in a company. Sometimes we get to pay a little less. But at the stage that we all come in, valuation is largely irrelevant. What matters is, like Mohit said, can these founders create an enduring and very, very large company? And that is mostly independent of what state of what the state of the market is, what part of the economic cycle we are in. So, to be honest, we don't obsess over valuations.
Mohit, today as we speak, why do you see more value? Is it, you do late stage investments as well, but what's a more comfort zone in the sense for PeakXV? Is it early stage where you find more value than what you would find today in a late stage?
Yeah, I think our DNA is early stage investing, which is when there is either pre-PMF or post-PMF. We're not we're not public market investors. So for us, it is more around whether it takes 5 years or it takes 10 years, can this company really grow up to become a very substantial part of the Indian economy? And that is what we are investing behind. I'll give you an example. When Deepinder started, just think of him as an early stage founder with all his insecurities. Imagine me saying that, Deepinder with insecurities. But he would have seen, Sanjeev Bikhchandani as the only founder that had sort of crossed $1 billion. Now someone starting up is looking at, Policy Bazaar, is looking at Eternal, is looking at Swiggy and so many other companies, and they're $25 billion companies now, Eternal. So now the next ambition has to be, how do I get to build a $50 billion company? How do I finally get us to a $100 billion company? I feel like that is the only thing that matters that will keep moving this economy forward.
So when you look at the top, you have the likes of the names that you mentioned, Eternal and Policy. But there is also a long coattail of companies who may not necessarily live up to the expectations, what they must have had in terms of private market. We have seen a lot of issues which have gone public, have fallen much before.
That's par for the course. I mean, this is why we call ourselves early stage investors. This is why we're called risk capital. The idea here is to actually back moonshot ideas, to back founders who are willing to break status quo. And failure is very much part of that journey that we should embrace. And so for us, we are very clear that the venture capital business is all about power law. What that basically means is out of the 30 to 40 investments we make in a fund, the top 5 investments will drive all the returns in that fund. And the rest will either make some money, some of them will go out of business, some of them will return maybe 2 times the money, but the real return of the fund comes from the top 3 or 4 companies within that fund.
Pranav, where are you looking for value today in terms of sectors beyond consumer tech? Like you said that today, AI remains one of your linchpin when you look at investing companies. Beyond that, what more are you looking at?
Yeah, so I mean, for us, it's less about value, it's more about potential. And so I'll answer that. I think we see a lot of things change. For one, this country is much more interested now in exporting, in changing its ratio of imports, services exports. Obviously, it's been a driver of the good fortune of this country for the last 25 years. Manufacturing has to catch up. So I think a lot of the top-down thinking now is directly influencing thesis. It never happened before, by the way. You could sit anywhere in the world and say, okay, India will build another food delivery company, another payment company, whatever. But today, in manufacturing, in deep tech, in drones, in defense tech even though we haven't done a deal yet, there's so much going on. And I think the first place I get optimism is that founders are betting their lives on building companies in these areas and taking a cue from the top down, right? India has been an adversarial country for entrepreneurs since independence. All of us know it. Many people here are older than me. They've suffered much more. But the fact that that attitude has changed and that founders are willing to take risks in these areas now, right? And VCs are investing in them. I think that's a big change in attitude. So I think that's where, if you work backwards from that shift, we're going to make more things for ourselves. We want to be less reliant on global supply chains. We want to have control on our currency. We want to have more accountability directly to our customers. Big brands are tired of having big vendors and so many delays and all kind of third order consequences when a war happens. That shift, as India goes from 4 trillion to 10 trillion, that's where all the value is going to come, right? So while we will build another cement company, another steel company, another pharmaceutical company, yes, India will do a lot of those. We will build more $50 billion tech companies. And I think as our equity market cap goes from 5 trillion to 10 trillion, it's not just GDP, but even the equity market cap is going to double. Let's see, hopefully at least 10% of that extra 5 trillion comes from tech, right? That should be the aspiration. That is the aspiration for all VCs in India. That's what I'm focused on now. So that's where the excitement is.
You concur with Pranav's views on that?
Yeah, absolutely. I think we are all chasing great entrepreneurs. We are not necessarily the experts in saying that the next great company will be in biotech. We believe that
it's a founder-led story.
It's a founder-led story, and if biotech, for example, is attracting a lot of great founders, our job is to assess whether that specific founder can build what they are planning to build. Is it feasible? Can they feasibly build a $5, $10, $15 billion company over a 10-year period? And if they do, I think we will go behind those spaces that the founders are getting.
Right. I think we are already out of time, but one piece of advice that you would want to give to an aspiring founder who knocks on your door, what would that be? Mohit?
I think all of us, even us as firms, when we were part of Sequoia, our job was to try and be the best VC firm in India and then complete Sequoia's necklace. Now as Peak15, the real opportunity for us is to be globally relevant. We happen to be from India. I think similarly, every entrepreneur here should think like, when I started this business, we were getting asked questions like, can we see real returns come from India? Can we see large businesses get created in India? I think we've all now proven that you can return billions of dollars from a single investment. But we still don't have a globally relevant company that's come from India, from the Indian startup ecosystem. So for me, when we're sitting here 10 years later, that's what I'd want to say, is just raise your ambition, let's just build some global companies from India. We all deserve to win globally, not just in India.
Pranav, is that the message you're also sending out?
Very good point. I think that ambition is, incredibly important. But I think the one thing I'm seeing more of is, I think founders have a new energy to their intrinsic motivation. It's more than money now. It's more than just wealth and other 20, 50 million, whatever, starting a family office. I think there's something beyond that which has changed. And I think if you're able to marshal that energy, a lot of risks are coming with AI and war and all this. It's going to be a tough decade for sure. But I think that intrinsic motivation, if we're able to deploy correctly, that motivation attracts more people with the same motivation. I think we'll start seeing these weird nuclei of energy that we didn't see harnessed in the same way before. So that gives me a lot of optimism. I hope that can cut us through all the pain that's coming next 10 years. So we hope for the best.
Ritesh, what's your one piece of advice?
I think over the past 20 years or so, we have primarily been consumers of technology. Our companies have consumed technology. And one of the reasons was the relative lack of deep technical talent in our country. I think AI solves that problem. You now no longer need 50 deeply technical people. You need 3 deeply technical people plus AI. And so I think the opportunity is right in front of us to actually start creating technology as opposed to only consuming it.
Okay. On that note, thank you, gentlemen, for taking time out. That was short and sweet, but hopefully that's a key takeaway.
Gentlemen, that was a fantastic conversation. Thank you very much. We'd like you to please stay on stage. Can we all hear it up with a round of applause, everybody? I'd like to ask Mr. VK to kindly present a token of appreciation to our panelists. First up, I'd like to call forward Mr. Mohit Bhatnagar with a round of applause, everybody, once again. Mr. Pranav Pai. And Mr. Ritesh Banglani. Thank you, gentlemen.